Hello?
Hello, Yaba. How are you?
I'm fine, thank you. And yourself?
Yes, I'm better. Looking very much good today. Yes. Now,
Okay.
I had something called gout coming up suddenly. That is
Oh, okay.
excess protein and excess uric acid. So, had to get warded for a couple of days. Now
Okay, that's fine.
back to work again. Okay, your
Okay then.
exam is happening on the 5th of December, is it? You said
Sorry?
exam is on the
6th of December.
Okay, right. Okay. So we can do some work. So what I thought was you have mentioned about the joint ventures and all that. So I prepared some slides on the joint arrangements, joint ventures, all that. Shall we go to that one?
Okay then.
Because
So when we finish, can you email that to me so that I can print it at
sure.
work?
Yes. Yes. I will
Okay.
immediately once I
Okay.
finish it, I will email it to you. All these slides.
Okay then. Thank you.
Right.
Thank you very much.
Right. So what I thought was let's because I think this is in F7. This is the first time they have introduced this one.
Yeah.
The relevant
Yeah.
accounting standard is IFR 11. Earlier during our time we had something called joint ventures. Now you know what is a parent and a subsidiary. Parent and a subsidiary is basically where one company has control over the other company. Generally, when you have more than 50%, you say the parent company and the company that you are controlling is the subsidiary company. Then we have another arrangement where we call associate investment. We don't have the control, but we have something called significant influence. So that is when you have about 20 to 49%. It is called significant influence, and the accounts what we do is what is called associate company, the equity method of accounting. Then we have the joint ventures. In joint ventures, everyone has equal share. So if it is a joint venture with 4 people, 25%, 25%, 25%, 25%. If it is if it is 3 parties, 33 and 1/3, 33 and 1/3, 33 and 1/3. No one controls, no one has power over the other. Everyone enters into a joint venture.
Okay, so no one controls.
No one controls, no one has power over the other. Everyone has equal share.
Okay.
That's what a joint venture is in a very simple language.
Okay.
So you can't apply the parent subsidiary concept. You can't apply the associate company concept. You have to apply a separate arrangement. Now it has been updated, and now it is called joint arrangements and related party. So let's look at some of the definitions that can come up. So joint arrangements, there are two types of joint arrangements. When you say joint arrangement, it is simply equal participation. So it can be a joint operation or a joint venture. So I want you to note down, a joint arrangement can be a joint operation or a joint venture. There are two types of arrangements. I'll come to that one in a minute.
Okay.
So whether it's a joint arrangement, whether the joint arrangement is a joint operation or joint venture will depend on the rights and obligation of the parties to the arrangement. Right. So we have to decide whether it is going to be, first of all, in the examination question, you have to decide whether it's a joint arrangement or joint operation or a joint venture. That will depend on the rights and obligations of the parties to the arrangement.
Okay then.
So joint arrangement is an arrangement. So joint arrangement, as I said, it can be a joint operation or a joint venture where the parties can contribute in different ways to the activities. I can be putting money. You can be the person who is managing the whole thing. Right? I have the knowledge. I have the financials. You have the knowledge. So we both of us get together to do a venture, and that kind of a thing is what we call a joint arrangement. So IFRS 11 covers up all types of joint arrangements, mainly the joint ventures or joint operations. So the joint arrangement it's not about the accounting part of it, right? The accounting can be, now for example, you and I, we enter into a joint arrangement to do something. You will have your own set of accounts. I will have my own set of accounts independent of the joint venture. Right?
Okay.
You in UK, I in Sri Lanka, we enter into a joint arrangement, maybe to you are going to send some goods to me, and we are going to. It's not just a pure export. You are going to send some goods to me, and I'm going to set up a establishment in Sri Lanka, and I'm going to sell that one on behalf of you, on behalf of both of us, and we make a profit and we share the profit.
Okay.
So it's not a question of you sending goods and you making a profit, or no, it is finally a venture, a separate venture. But remember, we have our two separate companies, our two separate identities are there, but we enter into a kind of a exclusive venture. It's not a permanent thing. It's a temporary thing.
Okay.
Right? So, so it's how the interest in joint venture is accounted by each party. So that is how we will decide whether it's a joint operation or a joint venture. So in a joint arrangement, two or more parties have joint control. Now that is the key word. Joint control. Joint control means equal control. Right? So sharing of control of an arrangement which exists only when decisions about the relevant activity require unanimous consent of the parties sharing control. No one can take a decision saying, I have the power. All three parties must unanimously decide, yes, we are going to price it at 25 pounds. Yes, we are going to send it to Japan, whatever. So what is a joint operation? So joint operation is a joint arrangement where the parties that have joint control of the arrangement have right to the assets and obligations for the liabilities related to the arrangement. So where each party to the contract, say two of us, we have the rights and obligations to the assets and liabilities of that joint arrangement. That is what we call a joint operation.
Okay.
You send vehicles from UK. I'm going to sell the vehicles to UK. So I have set up a kind of establishment here. The assets of that establishment is equally yours and mine. Liabilities are equally yours and mine. That kind of arrangement is what we call a joint operation.
Okay.
So what is a joint venture? Joint venture is a joint arrangement where the parties that have joint control over the arrangement have right to the net assets of the arrangement. Net assets. What is net assets? Assets minus liabilities. That is the ownership of the arrangement. Ownership. That means you are sharing the profit, all that kind of a thing. That is what a joint venture is. So very, very thin definition. In the joint operation, we have a right for all the assets and obligations, both sides. In a joint venture, it is simply we are going to have a separate venture sharing profits. That is what we call net assets, the ownership of the arrangement. So what are the forms of joint arrangements? So the joint arrangements can be a joint operation or a joint venture. A joint arrangement is structured to a separate entity. Now this is the important one, right? To a separate entity, maybe either a joint operation or a joint venture. It's a separate entity. It is separately carved out and converted into a separate entity, not a company, but a separate entity, separate business arrangement. So, should assess the terms of the contractual together with any other facts to assess whether they are rights to the assets and obligation for the liabilities. In that case, it is going to be a joint operation. If the rights to the net assets, then it is a joint venture. So, this is what I want you to note down this one. Rights to the assets and obligations, and for the liabilities, then it's a joint operation.
Okay.
Right, so net assets, then it is a joint venture. So this is what
Okay.
you need to know, because this was something that was introduced somewhere in 2011-12, that period. Earlier we did not have all these complications, but what happened was the people were misusing this joint venture concept. So the accounting bodies had to come out with something better. So they separated the joint operation and a joint venture into two different uh, setup of accounting. Joint operation is where you have rights and obligations for the assets and liabilities. Joint venture is where you have rights to the net assets.
Okay.
So I have a slide here. This you
Mhm.
can't see it in this one, but once you get it, you will be able to see it. So structure of the
Okay.
joint arrangement, the when it is not structured to a separate vehicle, it is a joint operation. When you don't have a separate business, then it is a joint operation. You and I, we get together where we don't form up a separate entity, we can't find out the separate the profit or loss, then it's a joint operation. Then the other one is what we can structure to a separate vehicle, a separate company, a separate venture. That is what we call a
Mhm.
joint venture. So
Mhm.
joint venture means you have a separate entity where they pay separate, the legal form is a separate vehicle, it's a separate entity, they have a contractual arrangement, and when relevant, other facts and circumstances. So this is the little chart which I put it up. Once you get it, you read that one. So
Mhm.
the clear demarcation is joint operation, not structured to a separate vehicle, but a joint
Mhm.
venture, it is structured to a separate vehicle.
What is the link between? Because there's an arrow that
This one,
joins the joint venture. Yeah. What does?
yeah, now that
Yeah.
shows even a joint operation or a joint venture will have the entity shall
Mhm.
have the legal form of a separate vehicle, will have the terms of contractual
Mhm.
arrangement, and will relevant other facts
Mhm.
and circumstances.
Oh, okay.
That is what is in that
Okay.
oval shaped thing, applies to both the joint operation and the joint venture.
Okay.
So contractual arrangement. So always in a joint arrangement, there has to be a contractual arrangement, which will distinguish a joint arrangement from an investment in an associate. Now this is the important one, right? There may be a multiple choice question coming up saying there is
Mhm.
a what distinguishes between associate and a joint arrangement.
Mhm.
Now if we just go and invest in a company 35% or 38% or 40%, you don't have a
Mhm.
contractual arrangement.
Okay.
There is no contractual arrangement saying that they are going to pay so much of dividend, or you are going to have an obligation for liabilities and you have a right for assets and all that. No, you will
Mhm.
be accounting and equity method of accounting. You will consider the profit turn. You will take the dividend off, take the original cost of the investment, and you do it. But when it is a joint arrangement, there's always a preceding the arrangement a contractual agreement.
Okay.
So if there is no contractual arrangement, then a joint arrangement does not exist according to IFRS 11. So
Okay.
you must have a contractual arrangement. So what is a contractual arrangement? It can be in different forms. It is a contract between the parties, where you have
Mhm.
signed a contract between the two parties, then it's a
Mhm.
contractual arrangement, then there's a
Mhm.
joint arrangement. Minutes of the decision between the parties, no formal contract, but the parties have met and they have recorded the decision, that is good enough
Mhm.
to establish a contract.
Okay.
Right? Or sometimes incorporated by articles or by laws of the joint venture. You have incorporated as a separate body, putting up all the conditions and the arrangement, that is also acceptable.
Okay.
Generally, the contractual arrangement should be usually in writing, but not necessarily it be in writing, because according to the contract law, even a verbal agreement can be constituted to be a contract.
Okay.
But generally, in business, very unlikely that we are going to rely on any verbal agreement. It will be a kind of a formal contract signed. Even but if the minutes are there, that will be good enough to establish a joint arrangement.
Okay.
So joint operation was a joint venture rights to asset. Now that's the first thing which I want to discuss. In the joint operation, the parties to the joint operation shall share all interests, rights, titles or ownership in the asset relating to the arrangement in a specified proportion, in proportion to the parties' ownership interest or in proportion to the activity carried out through the arrangement that is directly attributable to them. That in other words, all the assets belongs equally to each of the joint operation parties.
Okay.
One third, one third, one third. Liabilities also one third, one third, one third. When it is a joint venture, the assets brought into the arrangement are subsequently acquired by the other arrangement's assets. The parties have no interest, if no rights title in the assets of the arrangement. Now, when it is a joint venture, it is separated company and the limited liability company concept applies. You don't have an obligation for any liabilities or anything of that separate entity, right? If that venture busts out, bankrupt, you don't have to do anything about it. You don't need to bring any money or anything like that, because that's a totally a separate entity. So the joint arrangement has acquired the assets. So you put money, I have put money, and the joint arrangement. So it is Yaba and Kumar company, and that company has bought certain assets. We have no right for those assets to say half is mine, half is yours. No. Unless the company goes bankrupt and unless the company goes for liquidation, you can't claim half of the rights or whatever it may be. You can claim one third of the profit or half of the profit, but not the assets.
Okay.
That is the difference.
Oh, okay.
In the joint operation, there is no separate legal entity, and therefore the joint operation is like a partnership, right? Joint operation is like a partnership. So all the assets, liabilities, everything, everyone has the same equal share. But if it's a joint venture, when you form the company, when you form that separate legal entity, the asset belongs to that entity, the liabilities also that entity. We are just like the shareholders. But only thing difference is we are not controlling. We are not controlling. No one is controlling. So liabilities, obligations for liabilities. In a joint operation, the parties share all liabilities, obligation, cost and expenses. So all the cost, all the revenue, everything will be shared in proportion to the ownership interest in the arrangement or in the proportion carried out through the joint venture. The joint arrangement is liable for the debts and obligations of the arrangement. Joint arrangement is liable. That separate entity is liable, not Yoba, not Yaba, not Kuma. The parties are liable to arrangement only to the expected their respective investments. So I have put $100,000, 100,000 pounds. You have put 100,000 pounds. That's our responsibility. After that, we are not. It's like just investing in shares. Obligation to contribute any unpaid or additional capital to the arrangement or both. That is, if there is any unpaid capital, we have promised to pay 100,000, but we have paid only 80,000. So the balance 20,000 they have to bring it to meet the liability obligation. But you don't need to bring anything more than that, because it's a separate entity. So now I think it's very clear for you. Joint venture is a separate entity. Joint operation is like a partnership, where we come together for a particular joint arrangement.
Okay.
Right. So what about the revenue expenses? So assets, we know now what is revenue expenses, profit or loss. In the joint operation, the allocation of revenue expense on the basis of relative performance of each party. So say if the company has made 100,000 revenue, 25,000 of revenue is yours. If the company has spent 80,000 expenditure, 1/3 of the expenditure is yours. That's all. Right? In the joint venture, no, the each party, it's a profit or loss that we share, not the revenue, not the expenses. We share the profit or loss, the net assets.
Okay.
So accounting for joint operations. So IFRS 11 requires that the joint operation recognizes line by line the following the interest in a joint operation. So remember I said joint arrangement can be a joint operation or a joint venture. In a joint operation, it's like a partnership. So we go line by line. So we take assets, 1/4 of the assets, we will take it in our books. There is no separate accounting for the joint operation. 1/3 of the assets, we will take it into our book. 1/3 of the liabilities, we will take it in our book. 1/3 of the revenue, we will take it in our books. Right? All that we will take it into our own books, but because there is no separate joint operation accounts.
Okay.
Joint ventures, the relevant standard is IFRS 11 and IAS 28. You remember IAS 28 is the standard for accounting for associate investments, right? Associate. So remember there are two types of accounting methods for these where we invest. One is the consolidate, the acquisition accounting. Other one is the equity method. So parent and subsidiary, we go by the acquisition accounting. What do you mean by acquisition accounting? We take we add all the assets, liabilities of the parent and the subsidiary to prepare the consolidated statement of financial position. But in the equity method, in the associate company, what do? We take the original cost of the investment, add our share of associate company profit, deduct any dividends what we have received, and finally that balance is reflected as an investment in the associate company in the balance sheet. Same method is applied for joint ventures. So joint ventures and associate company goes on the equity method, right? Equity method. Parent and the subsidiary goes on acquisition accounting method. So the consolidated statement of financial position is prepared by including the interest in the joint venture at cost plus the post-acquisition profit less any impairment losses to the same as what you do in the investment in associate. Investment in associate also we take the original cost plus the share of post-acquisition profits minus any impairment. B, including the group share of the post-acquisition total comprehensive income in group reserves. If the joint venture has made some other comprehensive income, that also we take our share and include it in the group reserve. Consolidated statement of profit or loss and will include the group share of the joint venture's profit or loss, just like the associate company's profit or loss, and the group share of the joint venture's other comprehensive. So in simply, it is the same accounting treatment what we use for associate company, we use for joint ventures. Same equity method, same formats, everything is same. If it is a joint operation, we don't prepare separate that method. We just take 1/3 of the assets or 1/4 of the asset, 1/4 line by line, we will add it up, all revenue, all expenses, all assets, all liabilities. So there are certain disclosures what is given in the IFRS 12. It is all about the disclosures what we need to do. It's about the basically the idea of IFRS 12 is to provide as much as possible disclosure information to evaluate the financial statements prepared by the entity. So to that extent, the nature and risk associated with any entity, any financial position, financial performance and cash flows, and wherever it is required by IFRS 12. So IFRS 12 is the standard where we are required to give lot of disclosures, right?
Okay.
Together with the disclosure required by other IFRSs, do not meet the above objective. Entity required to disclose whatever additional information to meet the objective. So the objective is to give all sorts of information for the users of financial statements to evaluate the risk, the nature of risk with the entity.
Okay.
So I'm just talking about the applicability of IFRS 12 because this is also something that ACC has been testing all the time on the new areas, the new development. So IFRS 12 should be applied for subsidiaries. IFRS should be applied for joint arrangements. IFRS should be applied for associates. IFRS should be applied for unconsolidated structured entities. Now there are certain times we don't consolidate because for many reasons, but those are entities still which we have to apply the IFRS to it.
Okay.
Right? IFRS 12 does not apply to certain employee benefit plans. You remember these pension plans and all that kind of a thing.
Yeah.
Then certain interest in joint ventures held by an entity that does not share in joint control. So sometimes there may be a certain exceptional situations. We have an interest in joint venture, but we are not sharing in the joint control. Maybe some due to some legal reasons, legislative reasons, we are unable to control, although we have a joint venture, right? The government may come and say that, you can't control it or whatever it is. In that case, IFRS 12 may not apply.
Okay.
Investment entity that prepares financial which all of its subsidiaries are measured at fair value to profit or loss. That is fair value to profit or loss. Remember your IAS 39 financial instruments. There are 4 methods. One is the fair value to profit or loss. Fair value to profit or loss is applied essentially for short-term investments. Short-term. You don't have any intention of keeping it for a longer time. That kind of investment is called fair value to profit or loss. The other one is held to maturity. The intention is to hold it till maturity. You may not hold it till maturity, but the intention is to hold it to maturity. Right? Then we have the loans and receivables. Then we have anything that is not falling into any of these 3 categories, we put it under available for sale. So that's another subject. We will try to work it on that one, the financial instrument, because I think the F7 is dealing in these areas deeply in the last couple of exams. So entity discloses information about significant judgments and assumptions it has made and changes in those judgments and assumptions in determining that it controls another entity. So the people who are preparing financial statements must use certain assumptions. Sometimes you might have a 51% control, but you can't control. You don't have the power to decide on the dividend. But you are the owner of 55%. Now in Sri Lanka, we have the Colombo, the international hotel Hilton chain. The owners are the owners are the international hotel chain. They hold 100% of the holding. But the government of Sri Lanka, for whatever the reason, has taken over the company, and the government is managing the company hotel. Right? So even though they have the 100% control, the shareholding, still they are not the people who can decide on anything. The government has appointed the directors. The government is doing the whole hotel management, everything. So the profits will go to those people, but they have no control. So the government will even decide the dividend what they are going to pay even with a zero shareholding. So in that case, they have to use the significant judgment, significant assumptions and decide this cannot be consolidated. even though we are holding 100%, it cannot be consolidated because we don't have the power to control.
Okay.
Then we have to decide whether it controls another entity. Sometimes even without 50%, you can control another entity. If all the other shareholders are scattered all over, the 60% of the shareholders are outsiders, they are not meeting together. With your 40%, you can make all the decisions, then you are controlling even without a 51% holding. That can happen. Right? So in that case, you must consolidate. Even though it is only 40%, you consolidate. Even though it is 30%, you consolidate. So it has control, joint control of an arrangement or significant influence over another entity. So these are the difficult questions you might find it in your F7 paper. They might put up certain things and ask whether it is a company that we have a joint control or a joint arrangement or significant influence, or whether it is not. So you have to go to the circumstances, see the assumptions, see the judgments, and see whether it is all right for us to apply. Right? So the type of a joint arrangement, joint operation, or joint venture, when the arrangement has been structured to a separate vehicle. So always in a joint arrangement, you have to see whether it is a joint operation or a joint venture. How do you know that? It is, if it is structured to a separate vehicle, then it's a joint venture. If it is not structured to a separate vehicle, then it's a joint operation.
Okay.
Interest in subsidy. Entity shall disclose the information that enables users of its consolidated statement to understand the composition of the group. So whenever you are preparing consolidated financial statements, we must always tell the composition of the group, how much we are holding, how much the non-controlling people are holding. That is very important all the time. So that must be done. Understand the interest that non-controlling interests have in the group's activities and cash flows. Evaluate the nature and extent of significant restrictions on its ability to access or use assets and settle liabilities of the group. You may be controlling, but certain assets restricted. Now, for example, sometimes in Sri Lanka, when they form up a company, they can own the assets, but they can't sell some of the assets to foreigners. So the land, in most of the countries it happens, I think, the land, they can't sell it to a foreigner. So there's a restriction, so that must be disclosed. Evaluate the nature of changes in the risk associated with interest in the consolidated structured entity. The risk, whatever the risk that is there, right, political risk, economic risk, all those things must be highlighted. Evaluate the consequence of changes in its ownership interest in a subsidiary that do not result in a loss of control. Now you remember, already we are a subsidiary, we may have a subsidiary with 80% control, but we might sell 20% of that. Still, it is a subsidiary. 60%, still it's a subsidiary. But in that case, we have not lost the control, but our controlling interest has come down, the non-controlling interest has gone up. So we still consolidate. We still consolidate, take in the same scenario, we consolidate that 20% what we have sold, we will consider that as a profit or loss and show it as a profit or loss in the other changes, in the other comprehensive income and in the statement of changes of equity. But if it is 80% and if you sell 40% or 45%, then you become an associate. Right? Out of 80% you sell 45%, then you hold only 35%, then you lose the control. Then the accounting is, you have to, it's not no longer consolidated, it is associate accounting. So you are not controlling. So you have to see that kind of a thing and disclose all that. Evaluate the consequences of losing control of a subsidiary during the reporting period. So first scenario, you don't lose the control. Second scenario, you lose the control. So in accordance with IFRS 10, consolidated and investment entities required to apply the exception of consolidation and instead account for investment in a at fair value to profit or loss. That is, you don't consolidate it, even though you have 51% or 60%, but IFRS 10 says in certain instances you will not consolidate it, you will show it as fair value to profit or loss when that is happening, right? The fact that it is an investment entity, because you are a company that is this funds and all that, they invest money, but they are not investing to manage the company. They are investing 40%, 50% they might take, because you are an investment entity, right? You are not, the idea is to manage the company and to earn dividends and all that. No, you want to buy it as an investment property and sell it as an investment property. So in that case, you don't consolidate it. You don't bring it to IFRS 10 consolidation, because the idea is not for you to keep it. So that type of a thing, you work it through fair value to profit or loss. Essentially, they are short-term investment. Big investment, but short-term.
Okay.
So wherever that is done, you have to give the details of those things which have not been consolidated, the name, place of business, ownership, and the subsidiary, any arrangements that we have, you have to put it up, right? And whenever you cease to be an investment entity, that also must be disclosed.
Okay.
So interest in joint arrangements and associates, entity shall disclose information that enables users of its financial statements to evaluate the nature and extent and financial effects of its interest in the joint arrangement and associates, including the nature and effect of its contractual relationship with other investors with joint control of significant influence over joint arrangements and associates. So these are all disclosures in joint arrangements and associates. So again, I'm emphasizing joint venture and associate accounting is almost the same. Different, joint venture, equal control, associate, you have a significant influence. Nature and changes in the risk associated with interest in joint ventures associate. Structured entity, an entity that had been designed so that voting or similar rights are not the dominant factor in deciding who controls entity. Normally, the businesses are decided, the control is decided by the voting, shareholder voting. That's a normal thing, right? But where is designed so that voting are not the dominant factor, that is what we call a structured entity. Right? So basically the voting is only for administrative task or whatever the other things, but the whole arrangement is to a contractual arrangement. This is exactly what I told you. The Hilton hotel chain, it's a structured entity as far as the Sri Lankan government is concerned. They have a contractual arrangement with the owners of the international hotel chain to manage it, right? So the ownership is with the international hotel chain, but they have no voting rights. The voting rights are not the dominant factor in deciding who controls entity. The government controls through a contractual arrangement.
Okay.
So disclosure for unconsolidated structure. If these structured entities are not consolidated in the group, the following disclosures are required. So wherever this like the Colombo Hilton Hotel, where it is not consolidated, you have 100% holding, but it is not consolidated. In that case, why it is not consolidated? What is your investment? All that should be mentioned.
Okay.
So this is simply the theory behind the IFRS 11 and the IAS 28, IFRS 12, all the standards on the joint ventures. So what I thought was, I put up some questions for you. I send you the questions. Shall we look at some
I've got
questions?
I've got the question.
Okay. It's good for us to look at some other questions. It covers up it covers up both joint arrangements and associates. So let's
Okay.
pick up some of these questions and see whether we can get through these questions. Yeah, okay. Let's look.
Okay.
So EF, in addition to its other holdings, acquired a 30% stake in the 100,000 ordinary shares of SR on 1st January 2001 for 50,000. Right?
Mhm.
At acquisition, SR retained earnings were 22. During the year 2000, sold goods to 10,000 at a margin of 20%. As at 31st December 2004, a quarter of these goods had been sold onto third parties. Retained earnings were 90 and 90. Investment was impaired by 31st December. Calculate the consolidated retained earnings of EF Group incorporating SR at December 31st, 2004. So EF is the parent company. They have many other holdings, right?
Okay.
So because they have subsidiaries, they must prepare consolidated statement. Now I want you to understand, if you are a company, if you have a 30% holding in SR, you don't need to prepare consolidated accounts. Why? Because you are not a parent. If you don't have subsidiaries.
Okay.
Right? If you have a company with a 30% holding only, you don't need to prepare consolidated. Consolidated statements have to be prepared only when you have a subsidiary. So here in this company, examiner says very clearly, in addition to other holding, that means they have subsidiaries. But they acquired a 30%. If that other holdings are not there, you don't need to prepare consolidated statements. This was one of the questions in, I think, in F7 paper, right, where the one company, EF, they had a holding of 30% in SR, right? And they were asking whether the consolidated statement should be prepared or not. No, because associate company is not a subsidiary, and therefore you don't become a parent. You become a parent only when you have a child. Child is a subsidiary.
Yeah.
Right? So in this case, the consolidation has to be prepared because there are other holdings. So now, when you have a 30%, what is the investment, Yaba?
It's an associate.
It's an associate, yes. So we have to apply the equity accounting method, isn't it?
Sorry, say that again.
You have to apply the equity accounting method. Equity.
Yeah.
Right?
Equity accounting.
Yeah, that is IS 28. We have to apply it. So now we have to see, when did we take this 30%? We took it on 1st January 2001. What is the cost of the investment? 50,000. At acquisition, SR retained earnings were 22,000. During the end of 31st December, they have sold some intercompany. Let's keep it for the moment. As at 31st December, so the day we are going to consolidate, or there we are going to bring this associate company into the balance sheet this year is 31st December 2004. So the 2004 retained earnings of the ER group excluding SR, and SR as at 31st were 390 and 90. So we can see when we acquired the company, it was 22,000 and now it is 90,000.
Yeah.
Right. So what is the post acquisition profits? 90 minus 22, 68,000.
Okay.
Right, 68,000. What is our share? 30%.
30% of that.
Yeah. Right. So I'm going to put it up here. A few things. So post acquisition profits, our share is going to be, the parent share is going to be 68,000. That is 90 minus 22. 20,400 is our post acquisition share. Right?
Yep.
20,400. Then they say it has been impaired by 2,920. So 20,400 minus 2,920 is the amount that we can take from the associate company.
Yeah.
20,400 minus 2,920 is the amount we can take from the associate company. That works out to how much? 17,480.
Okay.
So that is the post-acquisition share that we will take. So remember the impairment, it applies only to us. Don't take 30% of the impairment. Impairment is 100% for us. Right? So 17,480 is the thing. Then what we ask is calculate the consolidated retained earnings. So the parent company has already 390,000.
Yes.
Parent company profits are 390. Now we have to see who sold to whom the good, right? SR sold goods to EF for 10,000 at a margin of 20%.
Okay.
SR sold goods to parent at a margin of 20%. So 10,000 is the whole the goods, 20% is 2,000, and they say a quarter of these goods had been sold onto third parties.
So
Quarter of goods, right? So 2,000, 1,500 is not yet sold.
Yeah.
Correct? 1,500 is not yet sold. Of that 1,500, 30% is the unrealized profit.
Yeah.
Right? So out of 390, we must remove the 450 because that is the unrealized profit. 390,000 minus 450. So that will give us the what will be reflected in the parent company 389,550 plus that 17,480 will be the total consolidated retained earnings. So that's all what we have to do it.
Yeah.
So what we have to do is we have to carefully look at the dates, look at what is, because now this question was big. So you have a lot of figures are given, right? So we have to look step by step, go what with the post-acquisition profits first of all. Go with the impairment second. Go with the intercompany last. Don't try to confuse everything. Try do it separately, bring everything together. So this is all what you have to do it. Is it clear?
Okay.
Right. Good. Okay. Monty PLC acquired 30% on the share capital of Tiger Limited for 75,000 on 1st July 2008. Monty PLC was to exercise significant influence over Tiger. During the year to 30th June 2009, Tiger made a profit after tax of 270,000 and paid a dividend of 50,000. At June 2009, the investment was considered to be impaired by 10%. What amount will appear in the consolidated statement of Monty Limited? So Monty is the company that is holding 30% in Tiger. Now you can see again, most likely they must be having other companies in the Monty group. That is why they have to prepare consolidation. If Monty was just holding 30% in Tiger, you don't need to prepare consolidated financial statements. Right? So now, can you see how you will look at this question, Java? Monty acquired 30%. So what is the question? What amount will appear in the consolidated in respect of? So it is equity accounting. What is the treatment? Original cost of the investment. What is the original cost of the investment?
75.
How much? Yeah, Monty acquired for 75,000. So 75,000 is the first figure, right?
Yeah. Yeah.
What is the next one? What you will do? Post-acquisition profits.
Yeah.
What is the post-acquisition profits when they acquire the company? Yeah.
It was 270.
Yeah, because they acquired it at the beginning of this year, isn't it? Right? So that's very good, right? Because they don't have a retained earnings or anything that you don't need to worry because they acquired it at the beginning of this year. So 270,000 is the full profit they made. So what is our share of the post-acquisition? 30% of that one, which is going to be 270 share of post-acquisition during the year. Tiger made a profit 270 on the 270, 81,000 is our share. They paid a dividend of 50,000. So when they pay a dividend of 50,000, we will get 30% of that one.
Okay then.
So we are
take our share of the dividend.
Yeah, we have to take off the dividend.
Okay.
We have to take the dividend. Then we have to look at the impairment. As at 30th, the investment in associate was considered to be impaired by 10%. Now this is a nasty question, I say. Now, on which figure will you provide the impairment?
If it's on the 30th of June, that is the following year. So wouldn't that be?
That is very good. That is very good, because lot of students, I'm very happy, lot of students would have provided 10% on the original investment of 75. But the important thing is they say as a 30th June was considered. So what is the 30th June figure? 75 plus 81 minus 50.
Okay then.
Okay. Of that one, 10%. So 75 plus 81, 156 minus 15, 141. 10% of that is impairment. 14,100.
Okay.
Very clear. Very good. Very good. That because lot of students thought on the original investment of 75,000, they went and made a 10%, which is wrong, because they say as at 30th June. As at 30th June, the investment was considered to be impaired. So we have to look at the value as at 30th June. So 75 plus 81 minus 15, of that 10% is the impairment.
Okay.
Right. That is the second question. So third question, I think, is on the joint arrangement. So this is what we just learned. Let's see whether we can apply our knowledge what we got on this one.
Okay.
IFRS 11 joint arrangement classifies joint arrangements as either joint operations or joint ventures. Which two of the following statements are true? A joint venture is always structured to a separate vehicle. Joint operation is never structured to a separate vehicle. Joint operation does not need a contractual arrangement. Joint venture must have a contractual arrangement.
Is it A and D?
A and?
D.
A and D, very good, dear. Because joint venture is always structured to a separate vehicle. But you remember I showed you that oval thing, even a joint operation can be structured to a separate vehicle.
Okay.
But it can be without a separate vehicle also. But joint venture always has to be a structured vehicle.
Okay.
Joint operation, it can be structured or not structured. Right? So joint operation never structured is wrong. It can be structured. But joint venture need to be structured, compulsory. Fourth one, yes, a joint venture must have because any joint arrangement must have a contractual arrangement.
Okay.
So A and D are the right answers. Excellent. So these are the type of questions you might find in your F7 paper.
Okay then.
IFRS 11 sets out the accounting treatment required for joint arrangement. Which two of the following statements are true in respect of this accounting treatment? Joint ventures must be equity accounted. Joint operations must be equity accounted. Joint ventures are accounted by including the investor's share of assets, liabilities, income as per the contractual. Joint operations are accounted by including investor shares. Yes.
Right. The equity accounting one is that I think A and B.
A and
B.
A is correct. Joint venture, I told you, it must be accounted just like the associate company, equity accounting.
Okay.
But joint operations, we don't go by that one. Joint operations, we take the proportion of assets, proportion of liabilities, I told you.
Yeah.
So again the answer is A and D.
Okay.
Isn't it?
Oh, okay. Okay. Yeah.
Joint venture always equity accounted. Joint operations we go by the proportion of shares, assets, liabilities, all that.
Okay.
Right? Joint operations is never equity accounted. Joint ventures equity accounted. Joint ventures are never in share of assets and liabilities, all that. Joint ventures is always equity accounted. Joint operations always share of assets, liabilities, etc. So A and D should be the right answers.
Okay then.
This the IFRS 12. So let's see whether we can get that one. The objective of IFRS 12 disclosure of interest in other entities is to require entities to which one of the following? Disclose information that enables users to evaluate the nature of risk and associated with interest in other entities and the effect of those on financial position, performance and cash flows. Eliminate intergroup transactions in the consolidated financial statements. Evaluate the performance of all investments made by entity, including those accounted for under IAS 39. Consolidate subsidiaries equity account for associate, joint venture, and disclose investment in joint operations or unconsolidated structures. What is the purpose of IFRS 12? Disclosure of interest. Why do we have to disclose it?
Why do we have to? Because it's not.
Yeah. Why do we have to disclose it? Look at the A, B, C, and D. Objective of IFRS 12. IFRS 12 is relatively new because people are not disclosing enough for users to evaluate the statements.
Okay.
Yeah.
So the answer will be
Yeah.
A.
A, yes, correct. The purpose of the IFRS 12 is to give information for the users of financial statements, mainly the shareholders, but there are so many other users of the financial statements for them to evaluate the nature, risk associated with interest in other entities and the effect of those on the financial performance, financial position, performance and cash flows.
Okay.
That's the purpose. Right?
Okay.
So that is why A is the right answer.
Okay then.
The question number 6.
Okay.
Can you do that one now?
Okay. On 1st of January 20.
Yeah.
So for having a company with subsidiaries acquired.
So you can see again a company with subsidiaries, because if it's a company with subsidiaries only, you can prepare the consolidated statement.
Okay. So 25% of Keeper for 650 when Keeper retained earnings were 720.
Yeah.
At 31st of December 2004, Keeper had a retained earnings of 1,600.
Yeah.
And Heron recognized an impairment loss for 300 in respect of its investment in Keeper.
Yeah.
What amount should be shown in as investment in associates in the consolidated financial statement of Heron? So
can we quickly do it? Yes.
Yeah. So the costs of the investment, which will be 25% of 650, which will be 650. 25. The cost of the investment was 16250. The retained earnings, right? At the end of, so the 25% of the retained earnings, will it be on the 1,600?
You have to look at always original cost of the investment plus post-acquisition profits. Post-acquisition profit is the difference between the closing and the day of the acquisition. Yeah.
So it'll be 1600
Hmm?
minus 720
Yeah.
times 25%,
Okay. Yeah.
which is 1600 minus 720 times 25%.
Yeah.
220. And then
Mm-hmm.
it says it had been impaired
Mm-hmm.
on an recognize an impairment in respect of. So was this impairment at the post?
Pardon?
It says because it says at the 31st of December 2004,
Yeah.
Keeper had a retained earnings of 1,600,
Yeah.
1,600, and Henry recognized an impairment loss of 300 in
Yes.
respect of. Oh, so the impairment is on the investment.
Impairment is on the investment. Yes, correct.
So the impairment would be on the 650.
On the 650. Correct. Exactly.
Okay, so do I do all the calculations and then take the impairment off, or I take the
Yeah,
impairment
you
of
can
the?
do all the other calculations and do it the impairment last.
Okay then. Okay, plus 1650. 162.5, and then minus 300. I got
Mm-hmm.
82.
Yeah, where did you go wrong? I know where you went wrong. Where did you go wrong? Why
Okay,
did
so
you?
the cost of the
Yeah,
cost of
yes,
the investment,
yes,
25%
yes.
times 650.
No, that is not 25% of 650 because they say acquired 25% of for 650. So the
Oh, for.
25% is worth 650. Isn't it?
Oh, okay then. Okay,
Hmm?
okay,
25% is worth 650. So you don't need to do anything.
okay,
You just have to take the 650 as the original cost of the investment.
okay.
25% of the
So,
original cost, the 650 is the value of the investment.
yeah, so 650
Hmm?
plus 1,600
Yeah,
minus 720.
yeah,
I got 880, and then times 25%.
exactly.
That's 220.
Yeah, correct.
So 220 plus 650
Yeah.
minus 300
Hmm. Yeah,
minus
that's correct.
300. I got 570.
Yeah, 570 is the right answer.
Yeah, okay then. That's answer
Understand?
B.
Hmm?
Yeah, okay.
570 should be the right answer, isn't it?
Yeah,
So you can
yeah.
see, you don't take 25% of the original cost of the
Yeah,
investment
yeah,
as it is, you take it up.
yeah, yeah. Okay then, thank you.
Right. So that is all right. So that's good.
Yeah,
So impairment,
okay.
100% of the impairment, investment, 100% of the investment, post-acquisition profits, we take our share,
Yeah,
unrealized profit,
yeah.
we take our share.
Okay then. Okay. So the next one says Holly owned 35% of Hook,
Mhm.
its only associate.
Yeah.
During the year to 31st December 2004, Hook made a profit
Mhm.
of 721.
Yeah.
This included sales of 240 to Holly,
Yeah.
on which Hook made a gross profit of 40%. 30% of the goods were still held in inventory by Holly
Yeah.
at 31st December 2004.
Yeah.
Holly considers its investment in Hook to have suffered a 20,000 impairment during the year.
Mhm.
At what amount should the share of profit of associate be stated in the consolidated
profit or loss. Now earlier all this time we were looking at the statement of financial position. Now this question we are trying to look at the profit or loss statement. How much? Because you remember in the P&L after tax we bring the investment in associate profit share of investment in associate company as a one line item.
Yeah. Yeah.
So how much should we show?
Okay. So we would have so the profit of 35 of 721, we take our share of 35%.
Yeah.
So 721 35. So that's 252.35, and then we need to do the intercompany.
Yeah.
The sale of 240. So 240 to Holly.
Yeah.
Which made a profit of 40%. So it will be 40%.
Yeah.
Times 240. Which is 24 times 4. 96, and then out of that it says 30% of it is still in inventory, so 96 times 30% times 30, which is 28.8, and then an impairment loss of 20, which will be taken out.
Yeah.
So I've got 28.8 plus 252.35 minus 20. 26. I got 261.
Yeah, where did we go wrong again? So let's see. Holly owns 35%. During the year, made a profit for the year 721 during the year. Hawk made a profit of 725. This included sales of 240 to Holly, in which you made a gross profit margin of 40%. 30% of these goods were still. So who sold the goods? Hawk made a profit for the year 700. This includes a sale of 240,000 to Holly, right? So the group the group profit for the year is 721,000. The parent, the associate company made a 721 profit. Of that, 35% belongs to us. Right? So 721, 35% is how much? 721, 35% to 350.
Yes.
252, 350.
252.
Yeah, 252 to 350. No? Now we have to look at this intercompany part. They had a sale of 240,000, right? The associate company sold to parent company or the Holly 240,000. On the 240,000, they would have made a profit margin of 40%. Right? 40%. So 240, 40% is their profit margin, and 30% was still in inventory. So the provision for unrealized profit is 240. 40% into 30%. Correct? And our share is only 35%.
Yeah.
So we have to take only 35% because our company holds only 35. So 240 into 40% into 30% into 35. What is the figure you are getting there?
Oh, okay. So I think I did the 30. I did the 40 to 30, but I didn't do the 35%.
No, yeah, because you know when they sell it, as far as the intercompany is concerned, it is only 35%. No.
Okay, that will be 10.
10 not 80 or
10,
something, no? Yeah.
10.09.
Yeah.
So plus the 252.
350, 10, 5, 252, 350 plus 10,080 minus the
Yeah.
total impairment loss, 20,000.
Yeah. Minus 20. Oh, I didn't get it right again. Hang on. So 252.35
252.35
plus the 1002.09.
10,080, no? Is it? I got 10,080. So just see.
I got 10.09. Hello?
200, yeah, 240,000, 40% into
Okay.
30%
240
into 35%.
times 30.
10,008, no?
Isn't it point times 40% times 30% times 35%?
Yeah, 240,000 times 40% times 30%
Mhm.
times 35%. Correct.
Times 30% times 35%.
10,080?
Yeah, 10,008.
80.
No, I got 1008.
Yeah, so that means that
10,
you went by 10 points, no?
okay.
So
Yes.
10,008 means 10,080.
10,080.
Yeah.
No, okay. Yeah, 10,080. Yeah.
Yeah.
So
correct.
that will be 10,080 plus
Yeah.
252.35
Yeah.
minus 20.
Yeah. Correct.
Okay. 242 I got. I
25.
must be doing something wrong.
No, 252, 10, 262, 242, I think. How much you are getting?
I got 242.
252. Both are minuses.
20.
Yeah, but 10 is minus, 20 is minus.
Yeah, 20. The impairment is minus.
Yeah, so 270 I'm getting.
Oh, okay, hang on. Because I'm doing it on the calculator and it's not.
Yeah.
252.35.
252.35 plus 1008.
Did
No,
you
sorry, minus.
Did you take? Oh yeah. You took the 10 away.
Yeah,
I
minus
got it.
1008. Minus 1008.
Oh, okay. Okay, then that's right.
Correct?
Oh, okay. Oh yeah. Okay then.
Yeah.
I understand. Well, I think my mistake was I was adding the 10 back instead of taking it off.
Yeah, I think. Yeah, so that's all right. So you know exactly what to do now, no?
Yeah.
Right, so that's all right.
Yeah.
So that is
So
question number 7. Let's look at question number 8.
the question 8. Which two accounting accounting to IFRS 11 joint arrangements are characteristics of a joint operation?
Yeah.
The party with joint control have rights to assets and obligations or liabilities of the joint venture.
Okay.
The party with joint control have rights to the net assets of the arrangement. The arrangement is never structured through a separate entity.
Yeah.
The arrangement is contractual.
Yeah.
So
this is joint operation.
Okay.
This is not joint arrangement. This is not joint venture. This is joint operation.
So C will be one of them. The arrangement is never structured through separate entities.
No, I said joint operation can be structured to a separate entity. Both the joint ventures and joint operations can be, but joint venture must be structured to a separate entity.
Okay.
Right? So this also can be structured to a separate entity. So well, they ask you what are the right ones, no? What are the characteristics of a joint operation? Look at the first one.
Yes. The parties with a joint control have rights to the assets. I thought the operation is the one that has access rights to the revenue and the sales.
Yeah, that is because the joint operation means it need not be a separate entity. It need not be a separate entity, but they have the right for the assets and obligations and liabilities.
Okay then.
Right. So the first one is right. A is right.
Okay.
And I think the
And
second, the next one is very easy for you now. Always it is a joint arrangement or joint operation, joint venture. I told you something must happen. What is that?
You must have a contractual agreement.
Contractual arrangement, isn't it?
Yeah.
So again, A and D are the right answers.
Okay.
Okay. Again, A and D are the right answers. Right.
Okay. Okay. On the on 31st of June 2003, Sugar entered into an agreement with the two other investors to establish a new entity, Spice. All three investors subscribed for 1/3 of the equity shares in Spice.
Yeah.
And each share carried 1 vote.
Yeah.
All three investors appointed 2 representatives to the 6-member board member board of directors of Spice.
Yeah.
All key policy decisions require the arrangement of 5 or the 6 board members.
Yeah.
A contractual agreement gives the 3 investors right to the net assets of Spice.
Yeah.
Which 3 of the following statements are correct in relation to the treatment of investments in Spice in the consolidated financial statements of Sugar for the year ended 31st September 2013? A, Spice will be treated as a separate simple repository. So A will be one of them.
Will be one of them because Spice will be treated as a joint venture because now it's a separate venture, separate entity will be treated because 3 investors sold 1/3 of the shares each, and the decisions neither, I said unanimous. So when you say 5 out of 6, it is unanimous because there are 3 parties to the agreement. So 2 parties should be fully there and 1 party, 1 director abstaining doesn't mean anything because it's not the directors, it is the 3 parties should reach a unanimous decision. So when 5 votes out of the 6, that means it's unanimous. If the examiner told 4 out of 6, then it's a problem. Then it's not a joint venture.
Okay. Right.
A is right.
Yes. Spice will be treated as a joint venture in this case.
Yeah.
But only because of the requirements that the key of at least 5 directors.
Yeah. Spice will be treated as joint, but only because of the requirement that key policy require the consent of at least no. It is not because of the 5 directors, actually because it is the unanimous of the 3 parties.
Okay then.
So B is not right.
Okay. Sugar should account for its share of Spice assets, liabilities, expense, and revenue in its own financial statement. That's correct.
No, that's wrong. Because if it is a joint operation only, Sugar will account the assets, liabilities separately. When it's a joint venture, we go by equity method of accounting.
Oh, okay. Sorry, I didn't read it properly.
See, you have to read the question very carefully, right? Because if it is joint operation, then they will account it separately. But because it's a joint venture, they will not account it separately. They will go for the D one.
Yeah. Okay.
D.
So Sugar should equity account for
Yeah,
its
should account for Spice's
spices.
consolidated financial statement.
Yeah, yeah, okay, yeah, I just agree with that one.
Yeah, yeah.
In Sugar's own financial statements, the investment in Spice should either be held at cost or in accordance with IAS 39.
Yeah, now that is, they are not
What
talking
does that
about the
mean?
consolidated financial statements. They are talking in Sugar's own financial statement. So in own financial statement,
Okay.
it's an investment that should be
Mhm.
shown at cost or in accordance with IAS 39.
Okay.
IAS 39 deals
Okay.
with it, it's available for sale, all that kind of a thing. So in its
Mhm.
own statement, in the consolidated, it is equity method. But in the own statement, it will be just a investment held at cost or in accordance with IAS 39.
Oh, okay. Okay, the last one. SD owns 80% of equity share of capital of N. In the year to 31st December 2009, N obtained long-term a long-term loan from a financial institution to secure a competitive borrowing rate. SD guaranteed the loan.
Yeah.
On 31st of December 2009, N showed no sign of financial distress.
Yeah.
Which one of the two following statements in respect of SD's individual financial statement is true?
All about the IFRS
N
12.
is
Okay.
N is showing no sign of financial distress, and therefore there is no need to disclose of the details of this arrangement. That's not true.
Yeah, that's not true. Whether it's
There is no
financial
need.
distress or not, it doesn't matter. It must be shown.
Mhm, yeah, there is no need to disclose details of the arrangement as the entities are part of the same group and their liabilities will be combined. That's not true.
No.
To enable users to evaluate the risk and borrowing, this arrangement should be disclosed. C will be correct.
Yeah, that's correct. To enable users to evaluate risk guarantee in its subsidiary, this arrangement should be disclosed. Very good. Yes.
Yeah. Okay. It says the arrangements consist of a contingency liability in the individual financial. That's not true.
This arrangement consists of contingent liability in the individual financial statements of SD? No, right? Because which one
Yeah.
of the following is
Okay.
in individual financial statements? So the only one is the C, enable users to evaluate the risk. This arrangement should be disclosed.
Okay.
So,
Yeah.
yeah. So,
Okay.
what you have to do is, I think, yeah, all right. I think that the answers came fairly well. There are a few areas which you need to be improving. That is, I think, again, it's
Okay.
more on the reading of the question, because you will see the straight away the sometimes it hits our question. We think it is something, but when you
Mm-hmm.
read it carefully, you will see it's another thing.
Yeah.
So you have to be
Yeah. It's
very,
true.
very careful with the joint arrangement, joint ventures, joint operations, because almost all are very similar. So
Okay.
again, to summarize, joint venture has to be a separate entity. Joint
Okay.
operation can be a separate entity, can be not a separate entity.
Okay.
All should be under contractual arrangement.
Okay.
Joint venture, always equity accounting.
Okay.
Joint operation, always assets, liabilities, revenue, expenditure, line by line added.
Okay.
But
Okay.
joint operation also can be a separate entity.
Okay.
But joint venture always has to be a separate entity.
Okay.
Joint operation can be a separate entity, can be without a separate entity.
Okay.
So that's the thing that you have to know. So this is all in the IFRS 11, the new standard. So these are the questions that can come up. So I have already sent you the questions. I'll send you try to get the answers also for you, and I will send you this PowerPoint slides for you so that you can go through that one and get a lot of ideas from that one.
Okay. Now, do you think, because it's new, would they set it up as a separate question on its own, or it might be in the multiple choice questions?
It can be even on its own in one of the sections. It can be, but they can't go beyond what we had discussed, because I discussed the entire IFRS 11 with you. So everything has to be within that what we discussed.
Okay.
They can separate. They can put up a separate question. It's all right, but so long as you make it very simple and try to understand it in the simplest possible, I don't think you will have a problem, Yama.
Okay. Okay then.
So, how is your day tomorrow? If you want, we can make it if you want it.
Yeah, I'll do tomorrow. I've got some questions that we did that you sent to me. So I've managed to do as much as I can from that one.
Okay.
What I've started doing is I've started doing some of the full questions.
Okay.
So I can send you that. We can have a look at that tomorrow.
Yeah, we can.
In the meantime, I need to read that. I need to read up on the joint ventures we just did.
Okay.
Just to get some understanding of it, and then yeah, we will take it from there tomorrow. Okay. After tomorrow.
Okay. So what I'll do is I will say tomorrow also we can make it at the same time, 12 noon.
Yeah. Are you sure you're not gonna go to church? I don't mind doing it later.
No, because Mama, since I'm 5.5 hours away from you, your 12 is my 5:30. So I'm all right.
So what time is it now then?
Now it's 7 o'clock here.
7 o'clock. Okay.
Yeah, yes.
Okay, that's fine.
So yeah,
12 tomorrow.
Yes. So because you must be 1:30 there, no?
Yeah, 1:30. Yes.
Yeah. So because of that, I'm all right. Because I'm good. Tomorrow I have to preach in the church, so I'm going early morning. But 12 noon is fine by me. Your 12.
Okay then. Okay. So
we'll make it 12 noon. I will. Any particular area you want to touch it or anything like that?
Maybe financial instruments.
Okay. Okay. So we will look at. I'll do some. I'll do some slides.
Yes, financial instruments.
Yeah.
And tax. But tax, it is not the deferred tax. I understand the concept. Is the tax in the publishing question?
Yes.
You know, that's easy one. That one is always tricky for me.
Yeah, okay.
I don't know, but it's very tricky. But apart from that, I think I'll go through the syllabus. I'm going through the pass card. Most of them, I understand what you're supposed to do.
Okay.
It's just the multiple questions I need to read. I need to read them carefully when I'm answering.
Yeah, that's correct. Yes. Anyway, tomorrow we will meet. I will prepare some slides for you on this one. Financial instruments, and we'll discuss something.
Okay then.
I'll see you tomorrow.
Okay then. Thank you very much.
Okay. Have a good day.
Okay. Thank you.
Bye.
Thank you. Bye.